great leader who is watching this video. We are in Phoenix and this is a live recording from Wall Street, New York City. If you see, this is a New York Stock Exchange. Yeah, it's very cold today. It's like around -2 degrees, but the show must go on, okay? Wall Street is very famous place. This place is related to money, investment, finance and everything. But right now we are focusing about investment because we are going to give you a summary of a book, very famous book. We call it Warren Buffett, third edition, which is written by Robert Hagstrom. Phoenix consists of 6 people. Right now, probably they are somewhere in the United States. Probably they are trying to interview Mr. Warren Buffett in Omaha, or probably they are going to learn something about investment in Wall Street in order to get A++ from Professor Roy Sample. Okay, and right now we are going to start about reviewing the book of Warren Buffett, third edition, written by Robert Hagstrom.
I believe Mr. Warren Buffett is one of the smartest person in the world.
He is definitely a great investor.
Mr. Buffett is a remarkable philanthropist. He has been donating more than $30 billion.
Wow! 3 words. He is amazing.
Warren Buffett has inspired me to be successful value investor.
Warren Buffett is a very wise man. Well, he is the father of value investment. And in terms of value investment, he doesn't just look at the long-term value of the company, but he also looks at the overall ethical contributions of the company to the good and well-being of the society as a whole. So I think the style of investment he does actually helps create value in the world as opposed to people who just speculate. And I think that is a very good example for the world to follow.
Pintu teater 2 telah dibuka. Para penonton yang telah memiliki karcis dipersilakan memasuki ruangan teater.
On June 26, 2006, Warren Buffett, who was then the second richest man in the world, stepped up to the microphone inside the New York Public Library and gave an announcement. He pulled out 5 letters from his pocket. He gave the first 3 letters to his children, a letter to representative of his wife, charity foundation. Those 4 letters promised give away a combined of $6 billion. The 5th letter was a surprise. He signed it and handed it to Melinda Gates over $30 billion, which is like Berkshire Hathaway stock to the world's largest philanthropic organization, the Bill and Melinda Gates Foundation. It was by far the single greatest amount of money even given away. Bill Gates said, Warren will be remembered not only as the greatest investor, but the world's greatest investor for good. Warren Buffett was born August 30, 1930 in Omaha, Nebraska. He was the 7th generation of the Buffett. It was said that as soon Warren Buffett was born, he was fascinated by numbers. He was already a calculating machine when he entered kindergarten. He also quickly found many ways to make money. He sold chocolate. He went door to door selling packs of gum and soda pop. He sold copies of newspaper and magazine. When Buffett turned 10, his father took him to New York and saw New York Stock Exchange. Later, Buffett enrolled at the University of Pennsylvania Wharton School of Business and Finance. Warren was unimpressed with the university. Wharton stressed in the theoretical aspect, while Buffett was interested with the practical aspect of business, how to make money. Buffett was interested with Benjamin Graham's book, The Intelligent Investor, which Buffett said was like seeing the light. Buffett later studied with Graham at the Columbia University Graduate School of Business. Buffett's grade for the class was an A+. the first A+ Graham had awarded in 22 years of teaching. Buffett came back to Omaha and began a limited investment partnership called the Buffett Partnership Limited. Buffett promised his partner that their investment will be chosen on the basis of value, not popularity, and that the partnership will attempt to reduce permanently capital loss, not short-term quotidian loss, to minimum. The Buffett partnership posted incredible number in its 5 years from 1957 to 1961, a period which Down was up 75%. The partnership gained 251%. By the end of 1969, the partnership had gained 101.56%. In 1969, Buffett decided to end the investment partnership. Then Buffett bought and took control in Berkshire Hathaway. In March 1967, Berkshire Hathaway purchased for $8.6 million the outstanding stock of two insurance companies headquartered in Omaha, which is National Indemnity Company and National Fire and Marine Insurance Company. It was the beginning of Berkshire Hathaway's phenomenal success story. In 2 years, the combined portfolio approached $42 million. This was a handsome portfolio for Warren Buffett. Today, Berkshire Hathaway is divided into three major groups: insurance operation, regulated capital-intensive businesses, and manufacturing, service, and retailing operation. Over the past 48 years, starting in 1965, the year Buffett took control of Berkshire Hathaway, the book value of the company has grown from 19 to $114 per share. Warren Buffett is not easy to describe. Physically, he is unremarkable, with looks that are more grandfatherly than corporate titan. Intellectually, he is considered a genius, yet this down-to-earth relationship with people is truly uncomplicated. He is simple, straightforward, forthright, and honest. Individuals like Buffett are a 5 sigma event, a statistical phenomenon so rare it practically never occurs. It would be easy to side with those who claim Buffett is a statistical rarity. No one has ever come close to repeating his investment performance. In chapter 2, I'm going to give summary about the education of Warren Buffett. Warren Buffett education is a synthesis of three distinct investment philosophies from the mind of three powerful figures. First one is Benjamin Graham, the second one is Philip Fisher, and the third one is Charlie Munger. Graham is considered the dean of financial analysis. Today, Graham is best known for two celebrated works: Security Analysis, originally published in 1934, and The Intelligent Investor in 1949. The essence of security analysis is that a well-chosen, diversified portfolio of common stock based on a reasonable prices can be sound investment. Step by step, Graham helped investors to see the logic of his approach. The second one is Philip Fisher. While Graham was writing Security Analysis, Philip Fisher was beginning his career as an investment counselor. Fisher graduated from Stanford Graduate School of Business Administration. And the last one is Charlie Munger. Charlie Munger grew up also in Omaha and met Buffett in 1959. Today, Charlie Munger continues as a vice chairman of Berkshire Hathaway. In a blending of intellectual influences, shortly after Graham's death in 1976, Buffett became the designated steward of Graham's value approach of investing. Buffett considered Graham to be the one individual after his father who had the most influence on his investment life. Buffett continued to embrace Graham's primary idea, the margin of safety. It has been almost 65 years since Buffett first read Graham. The key lesson that Buffett took from Graham was successful investing in forward purchasing stock when their market price is at a significant discount to their underlying business value. From Graham, Buffett learned how to think independently. If you reach a logical conclusion based on the sound judgment, Graham counseled Buffett do not be persuaded just because others disagree. Phil Fisher was in many ways the exact opposite of Ben Graham. Fisher believed that to make sound decisions, investors need to become fully informed about a business. That means investigating all aspects of the company. Fisher told Buffett not to overstate diversification. He believed that it was a mistake to teach investors to putting their eggs in several different baskets to reduce risk. The danger in purchasing too many stocks is that it becomes impossible to watch all the eggs in all the baskets. Investors run the risk of putting too much in a company they are unfamiliar with. In a very real sense, Charlie is the active embodiment of Fisher's qualitative theory. From the start, Charlie had a keen appreciation of the value of a better business and the wisdom of paying a reasonable price for it. Charlie helped Buffett appreciate the economic return that come from buying and owning great businesses. To this, Charlie helped educate Buffett on the psychological misstep that often occur when individuals make financial decisions. Okay, now let me pass the next chapter of this interesting book to my friend Vita Hanayori. It's your time, Vita. Go ahead.
There are some basic principles that used by Warren Buffett in purchasing a business. These principles related to business, management, financial, and market. For a principle related to business, there are three principles. The business need to be simple and understandable so you can make a wise decision, and then the business should have a consistent operating history, and then the business should have a favorable long-term competitive advantage. In terms of management, the management of this business or company should be rational so they can make a rational decision, and then the management should candid with its shareholder. They should admit mistakes and also share successes without hiding behind generally accepted accounting principle. And management should have the willingness to accept the fundamental changes and also have a strong communication skill to persuade owner to accept that changes. In terms of financial, their principles are: first, focus on return on equity, not earning per share, and then calculate owner earnings, and look for company with high profit margin, and for every dollar retained, make sure the company has created at least $1 of market value. Meanwhile, for market, there are two principles. The first one, you should understand the value of business. The value of business is determined by the net cash flow expected to occur over the life of business, discounted at an appropriate interest rate. And the last one is purchase the business at attractive price to protect you from downside price risk and also to provide opportunity for extraordinary stock returns. So that are the set of basic principles that used by Buffett in purchasing a business.
Thank you, Buita. Okay, now this book, the Warren Buffett Way, 3rd edition. Now I'm going to talk about chapter 4 with regards to common stock purchases, right? So in this chapter, actually, I learned that Buffett have become a part of Black-Scholes from Wool because of the way actually he acquired and bought the companies. As we can see here that he actually acquired Wells Fargo, General Dynamics, American Express, IPMI, and Haynes. For those of us hoping to understand fully Buffett's thinking, all of these common stocks purchases share one very important trait, that is, they allow us to observe his business, management, financial, and market tenets in action. And when we're talking about the market tenets, there are 4 tenets as discussed in previous chapter of this book. The first one is the business tenets. We're actually talking about 3 basic characteristics. The second one is management tenets, which actually talking about the qualities that senior management must apply. The third one is financial tenets, 4 critical financial decisions that the company must maintain. And the last one, last but not least, is the market tenets, that interrelated cost guidelines. There are 2 interrelated cost guidelines. I think that's my summary. I'll hand it over to Pak Ian. Thank you.
Thank you, Barudi. Now we are talking on portfolio management. There are 3 important portfolio management developed by Warren Buffett. 1. Building a portfolio for long-term growth. Number 2. Alternative measuring stick for judging the progress of a portfolio. And number 3. Techniques for coping with the emotional roller coaster that inevitably accompanies portfolio management. Warren Buffett is focusing only on a few outstanding companies, referred as a focused investor, and it called as an index investing portfolio management. Mr. Buffett categorized as an action-based investor type. His chain of thinking are: calculate probabilities, wait for the best odds, adjust for new information, and decide how much to invest. Critical on focused investing approach are: do not approach the market unless you are willing to think about stocks. First and always, expert ownership interest in businesses. Be prepared to diligently study the businesses you own and as well as the companies you compete against, with the idea that no one will know more about your business than you do. Do not even start a focused portfolio unless you are willing to invest a minimum 5 years or even longer, up to 10 years. Never leverage your focus on a portfolio, and accept the need to acquire the right temperament and personality to become a focused investor. Furthermore, I will pass to Pak Azari to continue. Please, Pak Azari.
In the chapter 6 of this book, Warren Buffett discusses about the psychology of investing. Basically, the psychology aspect of investing that investor must learn first is value of passion, and the second one is the short-term effect with emotional discomfort. Behavioral finance is the way to see the issues finance through the frameworks of human behavior. There are 3 important principles according to Ben Graham, who introduced Mr. Market approach in the financial analysis. First, looking at stock as business. The second one is margin of safety concepts. And the third one is the true investor attitude toward the stock market. Developing an investor attitude is a matter of being prepared first financially, and the second one is psychologically. Behavioral finance is an investigative study that seeks to explain market inefficiency by using psychology theories, observing that people make foolish mistakes and illogical assumptions when dealing with their own financial affairs. In this case, first, it could be overconfidence, whereby the investor not only make mistake decisions for themselves, but also have a powerful effect on the market as a whole. The second one, overreactions or overreaction bias, the pain of loss in far greater than enjoyment of gains. The third one is loss aversions. This is overconfidence, Investors not only make silly decisions for themselves but also have powerful effects on the market as a whole. The second one is overreactions bias. People tend overreact to a bad news, but they react slowly on the good news. And the third one is loss aversion. The pain of loss is far greater than enjoyments of gains. And the fourth one is mental accounting. The method people use to code functional outcomes. It refers to the habit of shifting perspectives of money as surrounding circumstances change. Tend to put the money into a different accounts, and that determines how they think about it. The fifth one is myopic or loss aversions. The longer the investor holds an asset, the more attractive the asset becomes, but only if the investment is not evaluated frequently. And the last but not least, the lemming factors or lemming fallacy, temptations to follow what everyone else is doing. Now we continue to chapter 7. Please, Mr. Johannes.
So, in this book, Warren Buffett tries to emphasize the value of patience as a critical point for investment. As you know that buy-sell decisions can occur within microseconds until decades. So there are two groups that he wants to emphasize basically. First is what he calls as a shorter time frame. Usually those speculators who work in short horizon and accept smaller return. They don't think that basically the value of patience is important. For them, actually just straightforward and sometimes take a little time to evaluate or recalculate the price earning ratio or dividend yield. But the second one is what he said is a long-term time frame. Usually those are investors who consider the value of patience as a critical point. Why? Because they compare three things. The first is the risk, the cost, and what about the return? Is it larger or smaller return? The common characteristics for this second group is basically they require reflection, judgments, and require expertise for the evaluation, and also operates in control manner. So what Warren Buffett is trying to say basically, in intelligence alone is not enough for the successful investment. What he's saying is that when you want to invest, three things that you have to consider. The first is what is about the company report and also annual report of your competitors. The second one is what is about the management, long-term capital allocations strategy, and the third one is you should ask some advice from your friends, colleagues, and even your financial advisor. And last but not least, think that the value of patience is a critical point for investment.
Okay, finally, who is Warren Buffett? He is an American business magnate, philanthropist, and also I would say the greatest investor in this world. His career was started as a investment salesman, analysis. He worked across companies before he owned Berkshire's Hathaway. Yeah, he is now chairman, CEO, and also the largest shareholder of Berkshire's Hathaway. What I like from Warren Buffett about his simplicity, even though he is one of the richest men in this world, he cares little about billionaire lifestyle. And his life, most of his life is spent about teaching people on investment. I think what I know about him is there's not money that he wants, but he really enjoy so much in watching money, how it can grow, and that's about the investment. Thank you.
Before we end our video presentation, my friend and I would like to thank to our great facilitator in finance class, Professor Roy Samber. Thank you, Professor, for your great teaching, for your amazing inspiration, for your remarkable sharing experience. Professor, thank you. We love you.
Hello, Prof. Roy. I just want to say thank you for the knowledge that you share during our corporate finance classroom. I think that you are a good facilitator. Not only a good facilitator, but you also a good professor, which has such wide breadth of corporate finance knowledge. I wish I could see you again and learn from you in another class. Thank you.
Our highest appreciation for great and enjoyable lecturing from Professor Roy Samber. Thank you very much.
And that's all, great readers. We have already covered 8 chapters from these great books. Yes, The Warren Buffett Way, 3rd edition from Robert Hagstrom. We in Phoenix hope that you get inspired from this great book, also gain knowledge and tips from our reviewing. Happy investing. Thank you for watching. Bye-bye.